But let's take stock of what's happening with the investment cycle. What are the driving factors, whether or not the investment cycle is going to sustain for long or not? We have with us two gentlemen joining in the show right now. Narasimhan Raghunathan, the CFO at Elecon Engineering, as well as Vimal Kejriwal from KEC International. Gentlemen, both of you, good to have you on the show. Vimal, let me start off the discussion with you. Many companies are highlighting a very healthy order book build-up. Is the order book build-up more positive than what one has seen in the past, and are you anywhere close to the pre-COVID levels at an industry level?
Yeah, good morning, Aisha. I think you're right that the order book build-up is probably, I'll say, more than pre-COVID level. But I think one rider which is there is that a large part of that is also coming from international. So some parts of the domestic industry are doing very well on the order book side or intake side. And some part of international, especially on the MENA area, etc., back on the back of the oil prices are doing very well. So for us, if you look at as a company, we have announced orders of almost 10,000 crores this year, which by itself is a record for us till date, either in the last year or pre-COVID also. And our order book plus L1 today is close to almost 30,000 crores, which has never been before. So I think on the top line side, revenue side, business growth side, we are seeing a great move all over the place.
Sure. When we talk about individual sectors, Vimal, we see sectors where capex was long pending, such as, metals, cement, and various other sectors as well. Which are the other sectors which seem to be participating afresh? And if you could just highlight for us, where is it that you are not really seeing traction still pick up?
Difficult to say where not, because if you look at what has happened, and I'll just give a number of civil. Our civil business last year did 1,000 crore. This year we'll do a double of it. Some part of it is coming from private industrial, which, as you rightly said, metals and mining is one sector, and cement. Third one, which we should now start seeing, is probably electronics and auto. Although auto is in a big bad shape right now, but I think with the EV thing happening, we are seeing now inquiries coming from a lot of auto players to build new plants on the EV side. So electronics and EV is one area where we are seeing traction starting to happen. The other area which we are now starting to see is warehouses and data center. So on the industry side, so cement, metals, I have not seen too much happening on the chemical, pharma, and others, where we had expected that post-COVID pharma will do very well, chemicals will do well, but at least as a company, we have not seen too many things on that side.
Your order book has gone up to pre-COVID level, but given that post-COVID the margins could also come under pressure because of uptick in commodity prices, how do you think you will be able to balance it? While top line is great, but more top line at less margins does not take you anywhere.
So Nikunj, what is going to happen is that the bottom line has been impacted last year, will continue to be impacted this year, so long as you are executing the old orders. Once those old orders get executed, and if you look at our bottom line also, last 2 years, we have been, at least 200 basis points below our stated margins of around 10%. But now that the new orders which are coming at new margins and new costs. So the advantage which you have now, that once you start executing the new orders, not only your margins will go up, and hopefully if the commodity starts slowing down, like we are already seeing steel slightly coming down, copper and aluminium also, then hopefully you will see an uptick in the new orders more than what you have bid for. That's the way I'm looking at it.
When is that transition where old orders will start moving out and new orders would kick in?
Absolutely.
No, but where is that transition? Is it this quarter, next quarter, 2023?
I think we'll start seeing the transition from Q4 in a way. I'll not say fully in Q4, but Q4 will start seeing, because most of the old orders will start getting executed fully. Q1 is one when we will start seeing, I think, a major impact of the new orders coming in.
Mr. Narasimhan also joins us now, represents Elecon Engineering. Mr. Narasimhan, good morning. Thank you for joining us. We've got Mr. Kejriwal from KEC International, and he's very happy to share with our viewers that his order book has gone to pre-COVID level. At Elecon Engineering, what is the current, what is the current situation?
Yeah, we have been good on order booking. We have been improving consistently, and in fact, it is also at the pre-COVID levels. And in fact, during the last year also, we did not see much of a significant drop, I would say. But we are definitely at the pre-COVID levels, and we are trying to improve on the order book.
Growth coming from more clients giving more business, new clients giving new business, or existing clients giving more business?
I would say we are focusing more on the exports where there is a potential, and domestic market we are only looking at sustaining and improving this thing. But I would say significantly we are looking more positive towards export market where there is a potential for us.
Sure. Vimal, if I could get back to you, the government has also been very supportive when it comes to spending. They've been very vocal about localization as well. Just wanted to understand how big a role is this playing for your industry per se, and how exactly could these measures being put in place be beneficial for you?
So honestly, we have not seen too much on the ground right now happening, especially on the private industrial side. What we are seeing on the public side is that on the metros and all that, that's an area where we are seeing a lot of spend. Railways had slowed down slightly, but I think it is picking up. So these are the areas where I'll say metro and railways is where we are seeing a lot of government spend. Private spend, as I already mentioned, what is happening. But I think beyond that, what government has done is, one is they have loosened their purse strings, and more cash flows are available to the EPC players. They have lessened or removed bank guarantee requirements, which was a major bane for many of the EPC players because they did not have limits, they had problems, and they were not able to bid. The flip side of it is that you are seeing too much competition. Like in a recent tender, we saw 50 players putting in a bid. Many of them would be non-serious. So I think some of the government measures are helping people. Some of them are not so good.
Sure. Mr. Narasimhan, what's your observation on how the new capex is getting divided between private as well as government spends?
I would also agree with him that we don't see much of a push from public sector from a localization point of view. At the same time, the general industry momentum has picked up, and that's what it is helping us on that front.
Mr. Narasimhan, how are you exporting when everybody is telling us that containers hi nahi hai? There is a shortage of container. It's difficult to move things out of India.
Yeah, that's true. In fact, we also face delays, and cost is also has significantly increased. But still, based on our manufacturing setup in overseas locations and assembly setup or stocking setup, we are able to manage. But I would agree that the constraints remain, wherein it is the container movement is slowed down, and we are trying to overcome it.
Mr. Narasimhan, is Elecon Engineering present in any of the so-called new age areas, whether it is EV or environmental or ESG related sectors, where suddenly things could come up? I mean, if you are in ESG directly, indirectly, things will look up. If you are in the business of giving better solutions for carbon emission, your business will look up. What are the high growth sectors you are in now?
I wouldn't say we are directly involved, because this is a traditional manufacturing based machineries which is required for manufacturing activities. We are not directly involved as such, except for few, for example, like sometime back we have got this flue gas desulfurization, FGD, which is required for all the power plant and this thing. So that's where we are also supplying, which may contribute to sort of ESG, but not directly we are involved in anything.
Vimal, for KEC to do well, there has to be a tailwind in the sector per se. Since you are in the business of, or I would say you're in power ancillary company, which has suffered because the power plants in India were not there. Now that things are normalizing, EV is a big opportunity. have your headwinds become tailwinds?
So, Nikunj, let me just clarify that our power T&D business is just 50% of our business now. Okay, we have got a large railway portfolio and a large civil portfolio. Both put together are almost 45% of our revenue, which if you convert to rupees, it will be around 6,000 crores. So I think that's the way of it. In power T&D, clearly in India, we are seeing a headwind still continuing. Okay, but there is a strong tailwind in the international arena where our order book, if you look at T&D, 70% international, 30% India. So be it Bangladesh, be it Nepal, be it Abu Dhabi, Saudi, Oman. So I think we are seeing a huge tailwind in those countries. India, not yet. I think India now with some government notifications on solar and saying that they'll have to pay transmission charges from 2028, etc. I think we'll see some fast tracking of solar plants, which will require quick transmission lines to be set up. So we are hoping that that gets converted into a tailwind, and with our Prime Minister promising, that we will have 500 gigawatts of solar in a particular 5 years. I do think that it's a time that the tailwind will start for the T&D industry in India also.
Sure, gentlemen. Great to have you both on the show today. We'll let you go on that note. Good having you with your insights, as always.
Thank you for having us. Thank you so much.
Thank you. Thank you.